Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY, the Qs, and IWM. This week I also have 5 trade ideas for us to check out towards the end of the video, so stay tuned. So kicking off the S&P analysis with our sectors, as we always do. Who was leading, who was losing, and where was the weight? Well, the energy sector certainly led the pack today, up 0.91%, and the XLP for consumer staples was down here at the bottom of the barrel, down 0.88%. Energy certainly does not make up a huge weighting in the S&P, but the XLP is not something to sort of write off as not bearing a lot of weight. It's not in the top 3, but it's also not down towards the bottom of the list, so it is slightly noteworthy that it was down 0.88. So what does make up the heaviest weights? Obviously the XLK for the tech sector, pretty much flat, down 12 basis points here. XLF, the second heaviest weighted sector, down 0.14, and then we have the XLV, the third heaviest weight for healthcare, up 0.36%. So let's check in on some of these charts and just make sure that risk isn't mounting in one place versus another. I would say the XLK looks phenomenal. Remember that we did make a new daily higher high, so we can afford to pull back and put in a new daily higher low. And that's exactly what it looks like we're trying to do here. So as long as price holds above 148, the daily uptrend is still well intact, and we can start to form a new daily higher high. I would argue with these lower wicks starting to show themselves, buyers are responding to lower prices, this little pullback that we've seen, and it could be, sooner than later that we get that higher high. So XLK looks phenomenal here. Next up, we have the XLF for financials, and this one is going to raise a question mark yet again. So if you remember what we did in last week's video, saying that because we've closed right at this 36.61 area, and now we're sort of trading right at it again, we're going to classify this as having some risk because it's just not apparent whether or not it's going to go higher or lower at this point, just hovering right around that line in the sand at 36.61. So still keep a very close eye on that number there. And I think what may help us sort of understand what's happening is just looking at the TNX, which of course is the 10-year treasury. And if we just zoom in a little bit, obviously we're still in a downtrend, which does not bode well for the financials. It helps tech though. So unless the TNX can start to peek its head above 1.3 or 13 here on the number, I would just say look for this to continue to go sideways in the XLF. I do think it was interesting that on today's session, we had the FOMC meeting, of course. The TNX did nothing, right? Obviously there was no policy change, but normally you see a little bit of fireworks on a Fed speak day, and it just didn't happen today. So keeping a close eye on TNX, how that relates to what happens in the XLF. So just flipping back over to check this out, I would say, obviously we discussed TNX higher over 1.3 would probably bode well for something like this in the XLF. Do keep in mind we have resistance at 37, so just overhead, but trading back into this range would strike me as more bullish for the S&Ps than something like the XLK just continuing to grind, right? Because the S&Ps have moved higher sort of on the backs of the XLK and the tech sector, right? Any sort of picking up of slack in the XLF would carry the S&Ps that much further. So a move like this would really propel the S&Ps higher, whereas a grind higher in the XLK is just going to kind of keep the grind, exactly that, just going on. If the two sync up, XLF moves higher and XLK moves higher, that's where you get a little bit more of an explosive move to the upside. But as it sits, again, just reminding you that we still are seeing a little bit of risk here, just the risk of the unknown and how 36.61 resolves itself. Next up, we'll check out the XLV for the healthcare sector. This one looks phenomenal as well, just like the XLK, seeing a new higher high, so we can afford to pull back and put in a new daily higher low. I would say the ideal place for it to form would be above the breakout area from in here at 129.22, but of course we can afford a deeper pullback, something that would look like this, as long as it holds up above 126.24. The quarter there, the 50 SMA is moving higher. I would say it looks phenomenal to continue the daily uptrend even on any sort of pullback here inside of the healthcare sector. Let's now take a look at volatility and what's going on here. I think it's noteworthy that volatility is elevated on this sort of earnings season. It's no surprise, but knowing that we're elevated as opposed to floating around down here at the floor strikes me as, something that's not going to catch the market off guard, right? We know that volatility is slightly elevated now, so we're not going to be, surprised to see a little bit more aggressive of a move lower inside of the S&Ps or an aggressive move higher, right? That volatility isn't going to surprise anyone. Whereas if we were down here towards that 15 floor, that can catch people off guard. That can start a little bit of a panic effect, in which case you see things like this, right? Huge spikes. Remember down here, we were trading at that 15 floor. It started to catch everyone off guard. We got that spike here. So now that we're coming in, we are slightly elevated already. I don't really see that as being a, huge risk factor in terms of volatility creeping into the marketplace. And also, in the past 2 weeks episodes, we've looked at the VVIX, and do note that this has come back down underneath, sort of our line in the sand at 120. So not a whole lot to write home about here, but I did want to bring that up since we have covered it in the last 2 episodes. Now flipping over to our S&Ps to discuss the price action and levels to watch into the end of the week. The first thing that I want to point out is, of course, the partial gap fill that we got on Tuesday. Now, to me, you can look at this 2 ways, and I'm going to favor one way versus another, but we'll lay out both scenarios. The first one, the one that I favor, is that, wow, sellers could not complete a move to a very obvious target here, and instead buyers stepped in before they really should have. So that's, quote unquote, what should have happened. The gap should have filled, and because it didn't, that's going to show a lack of strength from the sellers and more strength for the buyers, right? So that's the bullish scenario, and that's the one that I'm going to favor. The other scenario that you can look at here is, wow, the gap didn't fill. That's still going to act as a target to the downside. It's going to act as a magnet to the downside, and I don't really favor that option just based on a couple of things which we'll discuss right now. It still is a target to the downside, right? This 436 area is a target to the downside. The gap is a target to the downside, but I don't really think it's in play simply because we did form a new daily, or in terms of, bar by bar analysis, a higher low. We did not revisit that area of the chart, and we also formed a higher high on today's session during the FOMC meeting. We'll talk about some more divergences when we get to the internals, but I think any breaks over this 440.18 sends the market to blue sky territories, whole and half dollars, intraday levels that do form. We'll see another reason when we get back to the internal screen, but the other thing that I'm sort of thinking about is that we had the FOMC, it didn't drag the market lower. We have earnings, right, that have been sort of a mixed bag out of the tech sector. It has failed to really drag the market lower. So to me, all of this relative strength in the S&P is going to bode well for any breakout here to be accepted as a reason to go long in the S&Ps and sort of carry us into those all-time highs. So that's the more likely scenario I see playing out. But to the downside, of course, it is still a target. And then after that, you're really going to place a lot of emphasis on this support trend line here, because if we pull back into it, that's sort of your chance to say, okay, we've repaired this structure. Are we going to form now a new daily higher low? Obviously, this breakdown from in here gapped underneath it, but we've recovered above. So the support trend line has to be considered this time around if we do come into it. If it coincides, let's say that there is some nasty sell and it brings us into super support here at 431.70, I think, as long as we don't just slice right through it intraday, we start to hover around it, see a little bit of price reaction at it, that's going to be an easy long. And the reason I say easy is because we have tight risk, right? If it happens here, stop loss is just underneath. If it happens somewhere in here, your stop loss is going to go just under where the market's starting to bottom out during that day as we get into the support trend line. So either way, I see this as a bullish opportunity here in the market, just sort of holding a 2-day balance going sideways. Let's flip over to our market internals now and talk more about some of these divergences that we're seeing. If you're not familiar with this screen, get familiar. Top right-hand corner is going to tell you what this is all about, what it is, how you can set it up, and more importantly, how to use it to make better trading decisions intraday. Not a whole lot to write home about here in terms of volume reads on either Monday or Tuesday. Neither of them really got too impressive reads, as you know. We look at about 300 million to the upside or downside here, and only here on Wednesday, the FOMC day, did we get a read above 300 million. So I think it's noteworthy that as the market went sideways, we did see volume flowing into more up stocks as opposed to down stocks. Same thing here in the ADD, right? We had a flat day here on Monday, a little bit of a trending day lower there on Tuesday, but on the FOMC day, certainly a drive lower, but have recovered, and the majority of stocks on the New York Stock Exchange were moving above the prior day's close than below. So that strikes me as bullish. And again, on a flat day, that's sort of a divergence, right? Why are the majority of stocks moving higher and the market just going kind of sideways here? That's sort of a question mark, right? Do we see follow through to the upside now that we know that under the hood, it was a fairly bullish day, right? And the same thing goes for our ticks, right? We had this day here, didn't really amount to much. This day here built us back to just about the zero line. It didn't take us all the way there, but in any stronger selling, you want to see it build and hold, right? You want to see it hold down here at the lows. Minus 2,000 is usually a good read. So why did it creep higher? Again, seeing that we had a day down, but this crept higher, and now we're holding sideways, and we saw a bullish build here. I don't know. To me, it's just sort of starting to look a little bit divergent in terms of things under the hood that are fairly bullish, whereas the market's just kind of going sideways here. So on higher alert for an upside break as opposed to a complete fall apart to the downside. The other thing that I want to briefly point out is that we do have the all-time high being set in an overnight session here at this 44.1675 mark. So carry that forward. It generally generally does not tend to hold as the true all-time high of any given move. So let's move over now to our market profile. Again, we did a tutorial on this. If you're not familiar with this screen or what this means, if you think we're looking at Chinese now, definitely check out this tutorial in the top right-hand corner. It's going to clear some things up for you. I do want to point out that we have a poor low here from Tuesday's session. So if that is revisited, that should be treated as an area that's weak, and it should break on the retest. But what I also want to point out is that today's session was perfectly balanced. Good excess at the highs, good excess at the lows, and if we just draw in our bell-shaped curve, right, something like this, you can see that it was a fairly normal day. So that, to me, as we're trading here in the middle, is striking me as, bullish, right? Just holding here as opposed to expanding range to the downside or to the upside and forming poor structures. So again, holding and price acceptance here. Value is rather unchanged. If you look at value from here last Friday, Monday, of course, Tuesday, and Wednesday, it's all rather sideways to overlapping. That is price acceptance as opposed to clear price rejection. So to me, all of these things combined, knowing that we have an all-time high in the overnight session, we're a little bit divergent in the internals, the fact that value is holding well, the fact that we have a nice normal bell-shaped curve here, no screaming sort of structural deficiencies. Of course, there is the poor low, but overall, everything seems very healthy. It's going to be a very interesting open tomorrow morning. Do we open in the top 50% or 30% rather, or the bottom 30%, or do we open right in the middle and experience more balance? So these are all the things I'm thinking about, but to me, there is a slight edge to the bulls and a case for the market to move higher. Let's now finish up the broad market with the QQQ. One thing I want to point out about this, that again, it's holding sideways here. We can afford to pull back and form a new daily high or low, but if we just take a look briefly at what's going on in Facebook, especially in the after hours now that they've reported earnings, we'll go down to a 15-minute. Look at that. We did see a bit of a sell-off here, and that's obviously going to impact the QQQ and the broad market there, the S&Ps. So note that Facebook is gapping down. Is it enough to really drag the Qs lower with it? As of right now, just looking at the after hours data, not quite, right? So is Facebook anything out of the normal? Not really. If we flip over to the trade tab, what you'll see is that for Friday, we had about an $18 expected move. And if we flip back over to our charts, this bar here, the range is approximately 20 handles, $20 there. And now we're basing out slightly above the low of that candle. So almost $18 on the dot. Not a huge surprise in Facebook. It's just a move lower, but it's exactly what the market was sort of expecting, right? So back over to our Qs now and talking about levels to watch, knowing that we have a backdrop of bad, earnings there in Facebook. The earnings could have been great, but obviously bad price action that's bringing us lower. If we do to gap down into this range, expecting some more chop, two-sided action back and forth, I would place a little bit of emphasis on this low in here. Just knowing that it sort of acted as support on a pretty nasty day there on Tuesday. I was not at the screens as this was happening, but I do find it interesting that we reversed hard off of it and traded back into this higher range back above our 362.67. So note the low there at 360, just about the whole dollar. If we drop underneath, the target would of course be 355.20, but as the chart currently sits, it does strike me as more of a bullish hold up here towards the highs and reversing out of that 360 low. IWM is going to be the same story that we've sort of rinsed and repeated for the past, however many weeks now, trading right in the middle of its range. No real big updates here. As we always advise, never a good idea to initiate a new position in the middle of the range. Rather, when you're range bound, you look for longs off the bottom or shorts off of the top. And as we sit right in the middle, not a huge incentive to do one thing or another. If you're really aggressive, you could start to treat this here at 222.50 as a pressure cooker top and take it long for a small break there up towards 227. But again, really using IWM as more of a sentiment and sort of risk on, risk off signal. And it's just neutral right now. So not really a whole lot to say about the IWM. Let's get into these trade ideas now. The first one is on CCL, of course, Carnival Cruise Lines. And this one's been beat up pretty bad, but it's forming a bit of a pressure cooker top here at this 23.28 level. If we can get any acceptance above it, I would think that we start to see a little bit of a short squeeze based on the oversold nature of, this past move here. And again, I don't use short squeeze as a buzzword, but simply if shorts cover, that's going to add to the buying effect inside of the stock. Targets to the upside would be this sort of pivot high where we got a 2-day bounce up to at 24.32. Anything after that, I would look at prior support to offer some resistance at 25.70. Wouldn't really be interested in this trade if we break down underneath these two lows from these two large green candles at 21.72. So any consolidation in here strikes me as bullish, and then you take the break over 23.28. Next up, we have WFC, which is in the financial space. So you're going to have to monitor XLF on this one. I really like what's going on with this resistance trend line. It seems to be, to me, the most healthy of all the banks out there right now. You can look at some others that are just not nearly as close to their highs. This one is close to the highs. So sort of testing this resistance trend line here, coming off of a daily high or low. I would love to see it go sideways and boom, get something like that over this 2-day highs, right around 46 the whole dollar. So that might be a better trigger entry than over 45.51. So we'll get rid of that one. Your long is over 46. Just walk your targets up to the left. I would argue you have 46.64 and then 40. It's actually a little higher than that. I would say 47.35 after that 46.60 area that we just discussed here would be a nice upside target. Again, does it happen all in one day? Not entirely sure, especially if you have a weak XLF and the 10-year note is continuing to deteriorate. So keep all of those things in mind, but I do like the setup and the more importantly than the horizontal levels, the potential break of that resistance trend line in there on WFC. Not interested if we take out some of these lows from in here, that recent sort of set around 44.43. Next trade idea is on BA for Boeing, of course, and this one, very technical trader this morning at least, right off of the 50 SMA and forming an inverted hammer with a larger upper wick, basically looking for some more gap to fill here underneath 231.50, could potentially fill all the way down to 225.87. Again, does it happen all in one day? Not entirely sure, but this is a relatively non-supporting area on the chart, so it should be something that just moves lower with some ease as long as we can take out the low of today's session. It's sometime in the future, right? It could happen tomorrow on Thursday or even on Friday, but knowing that we got a very technical rejection off of that 50 SMA has me looking for the short here in Boeing. Next up, we have FCX, and this one has been a pretty highly volatile play. Just with all these gaps, generally the options premium in this name are pretty juicy. So looking for a long above the 36.81 3-day balance highs to target the 50 SMA, as well as prior area of resistance around 38 the whole dollar, or a short underneath essentially 3-day balance lows at 35.83 to potentially come down and fill the gap to the downside there, all the way down at 35.21 all the way. It's really not that big of a move, but I would be skeptical of the downside as opposed to holding out for the long side, preferring the break to the upsides, given that we have 3 days of balance, holding higher as opposed to deteriorating lower, but willing to trade this one in either direction here on FCX. And then lastly, we have UPS, there we go, not CPS. And UPS is another gap play with a consolidation range, so obviously holding 2 days now on the gap down. Your targets are very simple. If you take out the highs of the 2-day balance, you trade up towards the top of the gap here. 209.33 is the number. I'm not saying it has to go there all in one go, but relatively low area of resistance overhead in here. And to the downside, if you look left, we also have a gap. So this one is going to trade with relative ease in either direction. Underneath 190.16 is probably going to bring us down lower towards that 200 SMA. Again, is it going to happen in one day? Not necessarily, but very low area of support right in this area of the chart. So all that being said, I know it was a mouthful. I know we covered a lot today. If you enjoyed the video or learned anything new, let me know down below in the comments section or by simply leaving the video a thumbs up. And with that being said, I wish you all a green trading week.